We've had bonds trading firmer today as well, in line with a stronger rand. The benchmark R186 was bid at 9.73, as you can see there, percent, and that from a Monday close of 9.84%. The R207 at 9.26% from 9.33% previously. Traders now awaiting the release, of course, of local December consumer inflation data. That gets released tomorrow. Expectations there are for numbers to show that inflation rose significantly to 5.2% in December compared with a year ago, from 4.8% year on year in November. Time now to get into our weekly bond market report, and joining us on the line for that is Wikus Furstenberg, Portfolio Manager at Future Growth. Thanks so much, Wikus, for your time today. So let's take a look at the bond market, because South Africa this week setting a precedent as yields on government debt rise. The premium investors demand to hold the country's securities instead of US treasuries, for example, surpassing that of the average for its emerging market peers for the first time. Is that action fully warranted or a gross overreaction?
Hi, Alishia. I think it's warranted. I mean, if you look just at fundamentals, and let's ignore the debacle in December, and look at our term deficits and compare that to most of those markets, we still out in the cold, despite some improvements over the last 2 or 3 years. And if you take into account where the real repo rate sits relative to some of those markets, despite the fact that we increased the repo rate by about 1.25% since the low January 2014, I think there's still some work to be done.
So, with there not being a lot of people that are particularly optimistic about South African investments or bonds in particular, do you see the kind of performance put on today a simple knee-jerk reaction to what played out on the rand front? Take us through some of the activity you saw on the at the bond market auction today.
I think maybe starting with the bond auction, is that I cleared at market more or less. I don't think it was a bad auction at all, considering what's happening globally. I think in terms of price action, apart from that, today's move, I see it simply as discontinued market volatility. You're quite right. The market did respond to a strong currency. The market did respond to market reaction to what's been happening or unfolding in China. But, you know, in terms of the bigger picture, I think we should also see that in relation to what has happened in December, the big sell-off that we've had, and some market correction taking place at the moment. You can't read too much into that yet, though.
Especially where there's so much still up in the air. Of course, markets looking towards tomorrow's inflation data out domestically. What are your expectations on that front? Because that is a number that could well force the central bank to take more aggressive action at its monetary policy meeting next week.
Yes, I think our own forecast is slightly more bearish in the market. You mentioned the market expectation and consensus for about 5.2%. We're sitting at 5.4%. I think more important than that, though, is all eyes on what's happening to food prices, and whether we are going to see some sort of pass-through from currency depreciation. And clearly what's helping inflation at the moment is the fact that the rand oil price is so much lower, only because of what's happening to dollar prices of oil, despite what's been happening to the currency. So I think in terms of the central bank for next week, it's probably more about, you know, the big picture and the twin deficits, and where we sit relative to our peer group in terms of that real repo rate. So I would like them to adjust the repo rate again by about 25 basis points next week, and just to again commit themselves to that credibility that they're known for.
Of course, if we are looking at the big picture, what has been hanging as a very dark cloud over the South African economy is the potential for credit rating downgrades moving forward. How much risk are you pricing in that regard? Because we've certainly had Finance Minister Pravin Gordhan trying to downplay that, saying that South Africa is an economy that could well avoid going down that route.
I think indeed, I mean, that's clearly the risk, and you've seen all sorts of markets trying to price that risk. I mean, the 5-year CDS rate at a level, I think, that makes sense if you believe that South Africa lose that status and go to non-investment rating. local market, it's hard to price that, but if we compare levels to where we were before we were upgraded to an investment grade way back at the beginning of 2000, you can easily see the R186 or the 10-year adjust by another 50 basis points. Now, that's a very simplistic way of looking at life. We know that it's very hard to compare 2016 to 2000. A lot of things have changed. And of course, you also need to consider that foreign exposure to local bonds is significantly higher than it used to be way back in 2000.
Absolutely. Well, let's leave it there, Wikus. Thanks so much for having joined us on the line this afternoon. Wikus Furstenberg is Portfolio Manager at Future Growth.